Jeff Goll, Managing Director of Hillpoint. Macro's taking quite a big part of people's minds right now. So, can you just talk about workforce housing in general and kind of the supply-demand situation that you have in that space?
Yes, absolutely. And, when we formed our firm, in 2018, our co-founders, Kelly Mahoney, who runs construction, has built multifamily, student housing, senior housing, single family, and hotel. Stephen Campese's real estate private equity background, he invested in all those areas. So really it was a top-down look for us at really what was the most compelling opportunity set, what makes the most sense. And the area that very quickly jumped off the page at us as being exactly that, in terms of where we wanted to focus our efforts in the business over the long term, was workforce multifamily housing. Workforce housing, by definition, is market rate housing. It's affordable to people making between 60% and 120% of median income. Median income in our markets is right around $65,000 a year. These are your office workers, your hospital staff employees, distribution center facility employees, police, fire, teachers. This broad swath of the demographic population, it's housing that is attainable to that renter. And the stat that jumped off the page at us is if you look back over the past 20 plus years, there's been on average 350,000 units of multifamily built annually every year. 90% of that new construction has been and continues to be Class A luxury, all targeting the top 10% of the demographic population. So the inventory of housing that's affordable to this broad swath, this missing middle workforce demographic, has been stagnant and shrinking, depending on the numbers you're looking at, shrinking due to obsolescence. And so you've got, as a result, this huge structural housing shortage and affordability problem that's particularly acute in our markets in the Sun Belt. And then from there, we wanted to also kind of look at that subsector from more of a macro perspective and looked at data going back 40 years. And over the past 4 recessions, what you really have seen is it's been pretty durable. It's performed well over a cycle. Occupancy ranges between 92 and 97%, and rent growth has been between 3 and 4% on average. What you do see in kind of the 08 type scenario is, you have 1 year of bad debt, elevated bad debt as people lost jobs, they moved out, but other people moved in. And the narrative behind that is it's, really in that sweet spot where during good times, it's an aspirational asset class, people moving up into, this attainable product. And in tougher times, people moving out of luxury Class A and home ownership into this product. So that structural supply demand imbalance coupled with that durability over a cycle really is why we focused on the asset class. The only other thing I'd mention is, we asked ourselves, there's a huge need and a structural undersupply of this housing that serves this demographic. Why is nobody building it new? The answer to that question and our whole core competency at Hillpoint, the answer to that question is cost basis, is that given where construction costs are today, nobody can build and deliver a new product, underwrite $1,400, $1,500, $1,600 a month of rent and make the deal pencil from a financial perspective. Our whole core competency at Hillpoint is we can do, because of the way we're structured and the way we operate on the job site, we can build new Class A quality multifamily at a cost basis that we believe is 20 to 40% below where anybody else can execute. And that's what's unlocked the opportunity for us to execute in this space, now over the past 7 going on 8 years. And that cost advantage is really key to that execution. Everybody kind of sees the need for workforce housing. A lot of groups are trying to get exposure through what's called a value add strategy, which is buying older vintage stuff, putting CapEx dollars into it, fixing it up, and trying to push rents. But very few people are able to build new at today's construction costs and financing costs, they're not able to build new product that's affordable to this demographic. There are other groups trying. I think it's a very important distinction, to discuss how we are able to execute at that cost advantage versus what other people are trying to do. Our cost advantage is structural. It's because of the way we're structured. We are the developer to the GC. We charge zero development fee, zero GC fee. We participate on the back end in terms of our economics in the fund. And then from there, we're not a paper contractor. So we have our direct to sub labor relationships. Today, we have 7,000 guys on the job site that are doing the work. We travel them, we house them, we source materials and deliver them to the job. And we oversee every build and self-perform on every key trade. So typical development model, you have a development fee of 3 to 5%. That developer has to go out and hire a construction firm. That GC is going to charge 5 to 7%. 5 to 7%. And then that GC is going to go out in every market, go out to bid on every key trade, hire subcontractors to perform that trade on a turnkey basis. There's a profit margin in there for every one of those subcontractors of 10 to 25%. The way we operate, we don't do any of that, and we strip all that out, and we do that and lower the fees and friction and bring down the basis in the investment. The second thing we do is material sourcing, where we're direct to manufacture on everything and control our supply chain, which is very beneficial on cost, and it's very beneficial on control and certainty of execution. The third thing that we do, which ties it all together, is by building the same exact product everywhere we go. For us, it's 3-story garden style, 300 units is a typical deal. We have buildings that we lay out, and within those buildings, we build one unit type, all 2-bedroom, 2 bathrooms, all 1,170 square feet, same floor plan, same materials. That's our widget, and we're now building that 5,000 times a year. So our crews will show up, the materials will be there, they're building the same thing over and over again. Those 3 key things are what drives our basis down to a point where we believe is 20 to 40% below our next closest competitor. We have other groups that, we're the 5th largest developer of multifamily today in the country. The other top developers on that list, many of them have what they call a workforce product. The way that they're attacking the cost side of the equation is strictly on a cost optimized design and effectively, at the end of the day, building a cheaper box. So smaller floor plans, chopping off balconies, using lower quality materials, and doing all that and only saving, in our view, $5,000 or $10,000 a unit, and ultimately ending up at the end of the day with a lower quality construction, cheaper box. We're not sacrificing anything on quality. We're building a nice, big 2-bedroom, 2 full-size master bedrooms, ensuite bathroom, off-suite bathroom, balcony, quartz countertop, stainless steel appliances. We're building a nice product. Our cost advantage is structural. And so it's very different in the way that we're achieving that cost advantage. So we see other groups trying to build that workforce product, but going about it in a very different way.
Yeah, and I mean, when you see the pictures of these are really nice looking complexes. It just seems like there's such great value for money.
That's absolutely right. There's a huge value proposition there for the tenant at the end of the day. When you think about a workforce tenant and you think about somebody making $65,000 a year, in many cases, that median income employee is a renter by necessity, meaning they can't afford home ownership and they can't afford all the luxury Class A options that are available. But they don't qualify for affordable housing. That's catering towards people making below 60% of median income. That's, rental restrictions, Section 8 low income tax credits. And then you've got so they're in what's called the missing middle. And in today's world, they're living in 10, 20, 30-year-old product. And so we're getting some of those renters that are, now they're able to, for the first time, in many cases, for the first time in their lives, rent a newly built product. But we're also, in the majority of cases, our tenant profile skews to the higher end of the workforce demographic range. So our average income is $72,000, $73,000 a year. The average demographic for us is 20 to 40-year-old single or couple without kids who could otherwise live in a 1-bedroom. They're choosing to rent our 2-bedroom for more space, maybe they work from home, and so forth. So we're getting the renter by necessity, but we're also getting a lot of the renter by choice, which are people that are just choosing our product because it's very nice and there's a big value proposition there.
I think one of the questions I get a lot from clients is, when the funds start sending distributions back to clients, in what ways does that happen?
Absolutely. So the pro forma, so Fund 4 is a 10-year fund plus extensions, but we underwrite every investment on a 7-year hold. So the pro forma at the investment level is we will build, lease up, and stabilize in the first 2 years. And then by the end of year 3, we target a refinance event. And at that point, we assume agency execution, so Fannie Mae, Freddie Mac, and that will be sufficient to take out the construction debt and return 80% of initially invested equity to investors by the end of year 3. And then we'll hold in cash flow about 10% per year, and we'll distribute quarterly, after stabilization, and then ultimately look to sell by year 7. And that last big sort of gain on sale will get you 2.5 times your equity on a net basis and net 20% IRR over a 7-year hold. And the reason why we underwrite a 7-year hold is because we want to own these projects for as long as we think we as the manager can add value by owning them. So our biggest value add is our ability to build at a cost basis that's about 20 to 40% below what it's going to be worth when it's stabilized. But then the second part of our value add thesis comes back to the way that we underwrite our rents on the deal. And our underwriting is what we call comparative underwriting. And that is on every deal, prospective deal that we look at, we want to go into that market. We want to look within a 3 to 5 mile radius of our site for the 10 to 20-year-old competition. Because again, in our view, that's where the workforce demographic is living today. And we just want to say, are they fully occupied for that older vintage product? If so, what are they getting in rents? And if they're getting $1,500 a month in rent for that older vintage apartment, we're going to underwrite and anchor off of that $1,500 a month. And that underwriting gives us confidence that we should be able to go into that market, deliver our brand new nice product, and win that competition every time. So as a result of that, we're getting rents in line or above underwriting across the board in every market today. But then the strategy from there is we'll lease up and stabilize, refinance, return equity, de-risk the deal. And then after we do that, we should be able to continue to close some of that gap in rents over time. We don't underwrite for any of that, but it's very accretive if we can achieve that. And we want to maximize value at the asset level by maximizing NOI. So once we're at the top of the market rent, and that there's a buyer that's willing to come in and pay us for, their view of the market and so forth, which we may not necessarily disagree with, but those deals will be candidates for sale at that time because we've maximized, in our view, a lot of the value that we can control.
Obviously, the big word right now is tariffs. Could you just talk about tariffs, because you gave me a great breakdown of it, but it'd be great to just let clients know how it could impact the fund.
Sure, absolutely. And so a big part of our cost advantage on the construction side, and also a huge part of our certainty of execution on the construction side, is that we control our whole supply chain, and we are direct to manufacturer for all the materials that we source, and we OEM a lot of our own materials as well. And many of those materials come from overseas. And so, we've been exposed to tariffs in the past, notably in 2018, the first round of Trump tariffs. Anything coming out of China was hit with 25% tariffs. What we saw at that time was, for us, anything that we were sourcing directly from China on a blended basis, the absolute cost increase for us was about 8%, not 25%. And the reason why that was at that time was either one of two things, either factory offsets or maybe even government offsets on the back end, and also currency offsets, which offset the pricing impact or the cost impact of tariffs. What we also saw at that time was the further you were away from the source in terms of the manufacturing source, and the closer you were to domestic distribution, the closer you were to 25%. because everybody was using it as an excuse to pass through pricing. And so there was a lot more uncertainty the further down the supply chain that you were. And really, the way we think about it, and I think the correct way to think about it, and David, you and I spoke about this, was, for a lot of those materials we're sourcing directly, there is no domestic alternative. Flooring is a great example. So the LVP flooring, we're sourcing from the same manufacturer floor that Mohawk, which is a US-based company, makes all of their flooring. We have our own SKU and OEM product that's coming off the same factory floor that all of the Mohawk product is manufactured. And really, if you look at it more broadly, there are 95% of the world's LVT and LVP flooring comes out of 3 factories. They're all based in China. There's a coating that goes on top that determines color and texture. 100% of that comes out of 1 factory in the world, and it's based in China. So the question for us is not where are you? It's not a question of is there a domestic distribution alternative. The question is where are you in the supply chain, and do you control your supply chain? And for us, the answer is yes. So today we're sourcing materials, and I mentioned China because obviously that's top of mind for everybody. Today we're sourcing materials from China, but also Southeast Asia. There's a lot coming out of Vietnam, Malaysia, Turkey, Europe, Mexico, and South America, as well as domestically. And even the stuff we're sourcing domestically, we're direct on. But for all that stuff, there is no real domestic alternative. So everybody's kind of in the same boat. I think on a relative basis, we're going to be better positioned than everybody else. And so we put some analysis in our most recent quarterly update about the direct financial impact of a 10% tariff on goods coming out of China. For us, that's about a negative 4 basis point hit to our unlevered yield, assuming no factory offsets, no currency offsets, 100% pass through. And so today, if we're delivering to an 8% unlevered yield, that would equate to about a 7.96% unlevered yield. It's impactful, but again, the further away you are from controlling the source of, and the further away you are from the manufacturer, and the closer you are to domestic distribution, the more uncertainty and the more potential for more pass through. Just as everybody uses it as an excuse to pass through pricing. So no question that it's inflationary. But also to our point earlier about construction starts being off 60% from peak and falling further, a big part of that is construction cost. And so if it gets harder for other developers to build, those starts numbers will go down. And ultimately, as it is the case with, multifamily over time, that lower supply will lead to rents, that cost getting passed through vis-a-vis rents to the tenant. Which is a broader conversation, I think, but ultimately we're going to be in a better position in our view than most. The last point I would make on that is, as an investor in our fund, our investors are not at the risk for cost overruns. So when we underwrite a deal and commit to a deal, we deliver a construction budget to the fund. That's a stip sum fixed price, and we guarantee that cost. And so investors are not at the risk for cost overruns during the life of the construction. That's the risk that we bear. And we're able to mitigate that risk because as soon as we deliver that construction budget to the fund, we're doing the entire material buyout day one. We're taking physical delivery of all those materials day one. And we're either dropping those materials on site or we're storing them. And we have warehouses that we own and operate throughout our geographic areas of execution. And we have a domestic logistics team that's going to push those materials out to the job site when we need it.